just looking at the fundamentals of individual companies, which is what we do best in Cramerica, I think it's worth wondering what might happen if we stay on an even keel. We need to know if the market's gotten too expensive, sell, or if it's got more room to run.
All aboard!
Especially with oil having a monster runoff just today because of tension with Iran. So let's zoom in on the top 10 performances in the Dow Jones Industrial Average for 2019. See, we've got this will help us put it in context so we understand how we got up here and whether it is dangerous, whether it's safe, whether it makes sense. Number one is Microsoft. It's a $1 trillion household name with a stock that's up nearly 35% year to date. At these levels, now this stock trades at 26 times next year's earnings estimates. Sadly, that's lofty. It's a pretty rich valuation, which is unfortunate because we own Microsoft by Charitable Trust and always have to be concerned that it's moved up too much. On the other hand, the company has a habit of blowing away these estimates. Microsoft wouldn't be my first choice of these top 10 to go higher here. I think it's a quality company. I think that the stock may have gotten a little ahead of itself. No sin. That does happen. Number two, Cisco. Up 32%. Now, this is a brand new Cisco, people. The company has changed radically under the leadership of Chuck Robbins. The new Cisco is not just a networking company. It's also a play on the Internet of Things and on cybersecurity. Do you know it's the largest cybersecurity company in the world? Just buried within the housing that is Cisco, and it is doing fabulously. Best of all, even with everything it has going for it, do you know that this stock, it sells at 17 times earnings estimate. It's at a discount to the average stock in the S&P. And you know what I think it is? I think it is a steal. Buy. Third place, tougher for me because I love it, but it's rich as Visa, letter V. Now, it's up nearly 32% this year. It's not cheap. Trades at 28 times earnings. Honestly, I prefer American Express, even though it has some credit risk, or MasterCard, which is slightly more expensive, but has a faster growth rate. And that's why we own that one for our Charitable Trust. But that said, Visa, an erratic trader, prone to vicious dips, I think would absolutely be worth buying into one of those dips. Keep an eye on letter V. It trades wildly, and when it trades down, believe me, there's going to be nothing wrong with Visa. It is that well run. Thank you, Al Kelly, for doing so much for shareholders. Number four is American Express. It's up 31% for the year. This one's a keeper. American Express is exactly the kind of financial tech, you want to hear that fintech stuff? Financial technology stock that money managers can't get enough of, and it sells for less than 14 times next year's earnings? Terrific franchise. I got it in my pocket. I don't know about you. Fed about to cut rates. This is among the most desirable stocks in the Dow right now. And I've got to tell you, convincingly,
all aboard!
Buy!
The House of Pain.
No.
House of Pleasure.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.